What's up, everybody? So if you're a business owner, a people leader, marketer, then I have the perfect event for you. It's called Playbook 2022, and it's happening September 21st and 22nd. Get this, it is completely free, and this is the third year that Trainual has put this on, and it's going to be better than ever. They have amazing speakers like the marketing master himself, Seth Godin, the brother-sister duo, Allison and Wes Felix, and you may recognize Allison from the Olympics. She's a track and a field gold medalist, and now her and her brother own a lifestyle sneaker brand that was built by women for women. Plus, they have Allie Webb, who's the co-founder of Dry Bar. We've got Minion Francis, founder and CEO of the Cupcake Collection. Lisa Barnett, co-founder, president, and CMO of the organic baby food delivery company Little Spoon. I love them. They've got Caitlin Crosby of the Giving Keys and so much more. It's 2 days, September 21st and 22nd, all virtual. Trust me, guys, you do not want to miss out on this. You will learn so much on how you can build an incredible culture and a way more efficient business than ever. So go register now. It's playbook2022.com. That's playbook2022.com. Again, it is completely 100% free. I can't wait to see you guys all there. What's up, everybody, and welcome back to the show. And if you're new here, I just want to first off say thank you so much for tuning in today. And just to tell you a little bit about the show, this show was created and really aims to dispel the seemingly complex topic of personal finances and money management and debt and savings, investing, and even retirement. Well, I have been receiving a lot of questions from all of you, and the overwhelming theme this past week has been questions on investing. And because of that, today I'm really going to focus on answering some of those questions during today's episode. Also, if you have a money question, please feel free to send it to my email. If you guys haven't heard it before, it's financiallyfreejourneypodcast@gmail.com. And I'll make sure to go in and answer it either in a direct email back to you, or it might inspire an upcoming episode. You never know. So, okay, today let's talk about 5 simple steps to investing in stocks for beginners to really help you have a better idea of what that roadmap for success really looks like when it comes to investing in stocks. First things first, investing is a great way to build wealth and to really secure your financial future. This episode is going to go over some of those general steps for beginning investors. But remember, the best thing to do is to go talk to a professional about your specific money situation and really your investment goals. But with that being said, let's dive into the 5 steps to investing in stocks for beginners. So step number 1, decide how you want to invest in stocks. So an important thing to really understand is that there are several different ways that you can start investing in stocks. There are 2 different ways you can really start investing in stocks mainly. First, you can choose to be a DIY investor where you really go in and you pick stocks yourself, you manage it yourself, or you can be an investor that understands investing is important, but you would rather have someone else do all the legwork and manage the account for you. There are various kinds of accounts you can open to really accommodate the type of investor that you are. You can open a traditional brokerage account, an online brokerage account, or even a robo-advisor account. And I'm going to get into those differences in just a little bit here, so hold on for that. So, okay, now just to break down these account types a little further, you can open up a traditional brokerage account with an advisor. And this is a great option if you don't feel comfortable doing all of the market research and really understanding how to read business financials to see if the company is financially healthy and strong enough for you to invest in. Now, another option is opening up an online brokerage account. And this is a quick and easy way to get a brokerage account opened and still give you the option to really handpick the stocks you want to invest in, if that's something you're interested in doing, of course. And then another option that seems to be pretty popular these days is a robo-advisor account. And this type of account really gives you the benefits of investing in stocks, but it relieves you of the stress that really comes along with trying to understand what stocks to pick. Now, this type of account offers complete account management, which is similar to a traditional wealth advisor. Now, just so you know, these different options all come with associated fees, right? Nothing's free. So I would advise you to research each option and really weigh and measure the fees that are associated with the option, as well as, the risk that you could be taking by either managing the stock picks yourself or having someone else do it for you. There are companies that will claim that the accounts are free, the trades are free, but be leery because there are always fees associated because the company needs to make money, right? So do your research and understand what fees you're going to be charged. Okay. Step number 2, know the difference between stocks and stock mutual funds. I wanted to cover this because now if you have chosen to go the DIY route and you're going to pick stocks yourself, you have to really understand the difference between stocks and stock mutual funds. Now, there are, of course, more options than this, but most DIY investors find themselves choosing between these two different stock categories, which is why I really just want to touch on it quickly for you guys. So stock mutual funds and exchange traded funds, a lot of people, they're better known as ETFs. You've probably heard that acronym thrown around. It lets you purchase small parts of several different companies in one single transaction. Index funds and ETFs are a kind of a mutual fund that track an index. So for example, there's Standard & Poor's, the S&P 500 fund, which replicates the index by buying the stocks of the companies that are in it. So when you invest in a fund, you also own a small piece of each of these companies, which is pretty cool. You can put several funds together to build yourself a pretty good diversified portfolio. A great analogy here is picturing a basket, and the basket has a small piece of several different companies inside of it. That is similar to the option of buying an index fund, and it's just a great way to diversify against the risk that could come with investing more money into less companies. So let's talk about individual stocks really quick. If you have done research into a specific company, you can buy stocks specifically in that company, and really attempting to build a diversified portfolio out of many individual stocks is possible, but it's going to take a lot of money, a significant investment most of the time. So something I just want you to think about is that stock mutual funds or ETFs are inherently diversified because you're invested in so many different companies, and it really decreases the amount of risk that you're taking with your money. I wanted to go into step number three, set a budget for your stock investment. So a common question from a lot of new investors is, what should I invest in and how much money should I have to invest? Now, I've covered this in past episodes, but I really want to cover this again. You can start investing with as little as a couple $100 or even less. I mean, many people are under the impression that investing is for the sophisticated individuals that have a lot of money, they understand the stock market and trades and buys, but it's just simply not the case. That's not true. Investing is for everyone, and you can do it and be successful. You do not have to have hundreds of thousands of dollars to start investing your money. So I really want to make sure that you feel confident and that you are ready. If you are interested in it and you have, a couple $100, you're ready to start investing. Now, if you're wondering how much money you need to start investing, the answer is simple. How much does the firm require for you to deposit in the account that you open? So let's say, for example, you choose to open an account at Fidelity. What is their required minimum opening deposit? Now, these amounts can vary, and there are firms that don't have a minimum deposit requirement at all. So really look at that when you are thinking about how much money you have to start and what, firm you're looking at opening the account with. So just take that into account. The point here is, guys, is you don't need a large upfront investment to get going. Okay, you can do this. You can do this by really understanding how much money you have up front, and then really how much money you need to continue to save and invest in order to meet your investment goals. Now, are you saving for a down payment on a home? Are you saving for your kids' college tuition? Are you saving for your golden years? Whatever your investment objective is, you need to understand what that end goal amount is, and then you need to break that down as to how much money you need to continue to invest in order to meet the goal. So I want you to keep that in mind. Set yourself a long-term goal so you'll be successful. Now, if you have a smaller budget starting out, looking into and researching ETFs and mutual funds is a great way to get started. And another thought here is that you need to understand your risk tolerance. You're going to hear that word thrown around a lot when you're researching investing. And this is simply just how much risk are you willing to take. So you need to understand your risk tolerance as well as your time frame for the money. So going back to that goal, is it you have a kid in college in the next 5 years, or are you saving for your kid that's 5 and they're going to college in 15 years? Whatever the case may be, you need to understand the time frame for your money. The larger percentage of your money you have invested in stocks, the more susceptible they are to the fluctuation in the market. So if you're saving for a vacation that's next summer, investing in stocks is probably not going to be the best option for you. Now, if you're investing for your retirement, that's 15 years down the road, investing in stocks could be a great option for you. The rule of thumb here is that you should subtract your age from 100, and that's the percentage of your portfolio that you should have invested in stocks. So I'll just give you an example. So for me, I'm 32, so I should have 68% of my overall investment portfolio invested in stocks and equities. Okay? So step number 4. Focus on the long term. There are so many ways to invest in the market, and many of these terms you hear people throw around, like a technical investor or a fundamental investor, can make the whole thing really sound more daunting and complex than it is. The truth is here, guys, that many successful investors just stick to the basics, which usually means, using funds for a majority of their portfolio. And Warren Buffett actually talks about this exact point a lot. Warren once said that a low-cost S&P index fund is one of the very best investments that an American can make, and only choose individual investments if you really truly believe in the success of that company after carefully researching and studying their financials. I really want to emphasize that last part of what Warren said. Here's a piece of advice. Probably the best thing you can do after investing in stocks or mutual funds is to just not look at them. Unless you're trying to become a day trader and you're following a more complex strategy in the market, investing in stocks is really for the long run. You have to realize that investing your money doesn't mean success overnight. You have to allow your money to sit in the market and grow, which is why it is so important to understand your time horizon, like I was talking about earlier, which is really just a fancy way of saying you need to know how long you want to keep your money invested for before you need to use it. So step number 5, manage your portfolio. So the 5th and final step that I really want to go over today is to manage your portfolio. Now, I know I just told you not to check in on your portfolio every day because the fluctuations in the market is not good for your mental health. But if you need to manage your portfolio, which you do, you need to do it by checking and reviewing the performance of your investments every so often. Now, a general rule of thumb here is to check in on your investment portfolio about every 6 months or annually sometimes to review the performance. Now, if you're investing your money with a financial advisor, you're going to have the opportunity to really discuss any life events that may have happened and then adjust your investment strategy accordingly. The advisor is going to also give you advice on any adjustments that you may need to make, like rebalancing your portfolio. And that's something else I want to touch on. Rebalancing is something important that I think it's really important for you to understand the concept of. Remember earlier when I told you that general rule of thumb of subtracting your age from 100, and that's how much you should have invested in stocks. Well, rebalancing is a way to make sure that you maintain that correct percentage in your portfolio. Now, over the course of the year or years, your portfolio will fluctuate in value, right? It's going to have dividends pay out, and the stocks may increase or decrease in value themselves. This means that you need to move around your money to make sure that you still have that correct amount of your portfolio invested in stocks to manage your risk. Okay, guys, if you have any questions after listening to this episode, email me. I love your emails, and I do take the time to answer all of them, and a lot of them inspire the episodes that come out. My email again is financiallyfreejourneypodcast@gmail.com. for all of your money questions. And just remember, all questions are great questions, and I love answering all of them. Thanks again for tuning into today's episode. And if you haven't already, please go subscribe, rate, leave an honest review for the show. It really does help the show become more discoverable to other listeners who are looking for podcasts to help them with their money goals. Also, make sure you go follow us on Instagram. It's at Financially Free Journey, where I share more tips and motivational quotes to help you with your financially free journey. Until next time.